All right, kicking off the week with a little bit of optimism here. 30 minutes, though, until the start of cash trading. I'm Matt Miller.
And I'm Danny Berger. Shana AZEK and Katie Greifeld are on assignment. Bloomberg Open Interest starts right now.
Kicking off the week with confidence, traders bet President Trump's reciprocal tariffs will be targeted on April 2nd rather than sweeping. And China steels itself for shock. CEOs including Tim Cook and Albert Bourla are in Beijing as Chinese leaders prepare for tariffs that exceed expectations. Plus, BYD beats. The Chinese electric vehicle maker posted more full-year revenue than Elon Musk's Tesla, even as it sold fewer cars. Let's take a look at where markets are trading. As I said, we're looking at some gains this morning on futures. S&P futures now up 1.2%. NASDAQ futures up 1.5%. You really do have tech stocks leading the way, like Tesla, like Meta, like AMD, all putting up big pre-market gains. The 10-year yield rising back up to a 430 level right now, so investors selling treasuries on hope that Trump's tariffs will be targeted. Let's take a look at the auto sector in particular would benefit from more targeted tariffs. You can see Tesla, the biggest gainer today, up 4%, and retail investors just piled into Tesla over the last couple of weeks, even as the stock sunk. BYD just out with earnings, over $107 billion in full-year revenue. The stock trading for $106.50. And we're looking at General Motors and Ford also putting up gains on hopes that President Trump's tariffs will be narrower than expected. Danny, what are you watching?
It's much of the same story, Matt, because it's not just autos that are one of the sectors that might be spared. If we don't get those sectoral tariffs, if it's just more reciprocal on countrywide type tariffs, semis is another one of those. Semis across the board leading the way higher for tech. Micron, Broadcom, AMD, Intel, all up at least 1%, getting a lift again on targeted tariffs. Now let's stick with that because President Trump has been setting the stage for his big announcement next week.
April 2nd is going to be Liberation Day for America. We've been ripped off by every country in the world, friend and foe. That money's going to be coming back to us in the form of tariffs. They're tens of billions. It's going to be numbers like nobody's ever seen.
So as far as we know right now, those tariffs might actually be more targeted, potentially sparing a number of specific industries, including the automakers and semiconductors. Let's get the latest from the White House with Bloomberg's Tyler Kendall. Tyler?
Yeah, hey, Matt, it appears the White House is narrowing its focus ahead of April 2nd. As you said there, Bloomberg News reporting that we might not get those sector-specific tariffs. This has changed as recently as last week, where we heard President Trump saying that those sector-specific tariffs could have been stacked on top of the reciprocal tariff plan. Now, those industries, as you know, are the ones that you're talking about and the ones President Trump has singled out when it comes to autos, chips, pharmaceuticals, and lumber. Also, importantly, this Bloomberg News report going on to say that those reciprocal tariffs might be a little more tailored and that some countries could be excluded if they have no tariff barriers against the U.S. or they run a trade surplus. But this really is a shift in at least the messaging from this White House. You had Kevin Hassett, for example, on Friday saying that the markets need to change their expectations because not every country cheats the U.S., as he said. But really, we didn't start to hear this rhetoric until last week when Treasury Secretary Scott Bessent outlined that the so-called Dirty 15, the top 15% of countries that run this trade imbalance with the U.S., could be targeted. But to be clear, Matt, we are still expecting tariff levels could reach their highest levels in potentially decades. And this White House is banking on that tariff revenue, but it is a market shift.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall reporting live from the White House. Meanwhile, China is hosting its annual development forum. Global executives arriving in Beijing as the nation moves to reassure everyone it's open for business. The premier, Li Cheng, saying, quote, instability and uncertainty are on the upswing. At this time, I think it is even more important for each of our countries to open up our markets. For more on the forum, let's bring in Bloomberg's Justina Lee. So, Justina, we know at the same time, that's not Justina. That's Isabel. Let's get to Justina Lee. Justina, we know that at the same time as saying, you know, we're open for business, they are prepared for shocks that exceed expectations.
Yeah, that's right. And it's pretty clear who the audience of this message is, because they said, you know, they're prepared for these shocks But they also emphasize that, it's mutually beneficial for the U.S. and China to kind of move toward kind of cooperation, that kind of further fragmentation of economies is not good for anyone. And I think you can see that both sides kind of came to Beijing with pretty strong stances, because on the other hand, we have Republican Senator Steve Daines also in Beijing, and he kind of told the Chinese side that the U.S. would have to see more progress on stopping the inflow of fentanyl ingredients into the U.S. before kind of any further progress on those talks could be made. And I think kind of given that China kind of feels like they've done enough, you can see how there could be a bit of an impasse there.
Justina, considering that we're going to be getting reciprocal tariffs next week, is there also a sense that it's not just American executives that are turning to China, but it's those that are being targeted by the U.S. looking now to China as more of an economic partner than perhaps they would have in the past?
Yeah, and I think, that is definitely what China is hoping for, especially with kind of progress on the AI front, kind of putting China at the center of kind of this global technological transformation again. And at the same time, in a sign of its preparation for these tariffs, China recently has talked, about kind of increasing kind of stimulus on the consumption front and kind of making sure that China is prepared economically kind of for these tariffs.
Justina, thank you so much. Bloomberg's Justina Lee there. Now back to tariffs and their impacts on autos, semis, and metals. Now joining us for real this time is Isabel Lee here with a closer look. Isabel, really great to see you. So we got a rally underway. What are you focused on?
So equities are really gaining ground on signs that Trump's tariffs will be more measured than previously expected, especially those with global exposure. So let's look at autos. We have Tesla, GM, Ford, and Stellantis. So they're the big three, and Tesla. So look at those automakers. They're all edging higher. They've really been struggling to come up with a game plan to get ahead of levies. Some are ordering ahead, or some are canceling orders. And any relief will just really buy them more time to adjust and to really look at what their new year would be. And these automakers have aggressively sought to halt or revise Trump's tariffs over concerns about what they call catastrophic effects. And we have a lot of estimations online saying that this might add tens and thousands when you buy a new car. So that's automakers there.
Yeah, absolutely. Costs and chaos is how Ford CEO Jim Farley described the wake of tariffs. I want to talk, though, about semiconductors. The SOX index has had a pretty rough start to the year, down almost 10%, so it's been decimated in terms of U.S. Semiconductor makers. What are you looking at?
But you look at those chips, we have Qualcomm, Broadcom, Intel, it's generally just green on the screen, and substantial tariffs on chips will really increase the price of chips one way or another, and will increase the price of electronics for Americans. So when you buy a new cell phone, Matt, it'll be more expensive. And Trump has argued that tariffs are actually giving the same outcome as the CHIPS Act that his predecessor, President Joe Biden, did. And when it comes to chips, at least in the U.S., Malaysia, and Singapore will be more affected. But for now, shares are edging higher. We have NVIDIA CEO saying, though, that tariffs won't affect them so much. But I guess it comes more with their production.
Could we just put a bow on this with one of the other sectors, maybe the final sector that's really been under concentration, and that's been metals? I mean, looking at the price of copper, finally above $10,000 on the LME, there seems to be some real optimism for the sector.
Lots of optimism. So I was reading BNs, and they call steel the gray metal. So there's a lot of optimism there. We have a United States Steel, Nucor, Alcoa. So a lot of nations aspire to have a robust steel economy. We have Trump, as we know, looking at it as a symbol of manufacturing might. And of course, you see those three edging higher. So, but we have Matt Maley in his note today. He said that it's really not about tariffs why we are seeing optimism, but really earnings. So I think it's still a guessing game on what's driving equities, at least for the past few weeks, with a headline shocker day after day.
Isabel Lee, thanks so much for joining us. Isabel covers stocks for us on the other side of the building here. Yeah, really the focus on earnings is, I think, parallel to the focus on tariffs, right? Mike Wilson also came out with a note from Morgan Stanley saying that the dip in the dollar is good. It's off, I think, 3.8% year to date. But it's also good that downward earnings revisions have bottomed out, especially for the Mag 7. And now we can start to see them at least stabilize, maybe climb.
This is the problem for earnings, though, Matt, is that there's this really fascinating study from S&P that looked through, I don't know, about 500 different earnings transcripts. Companies aren't incorporating tariffs into their outlooks because they have no idea what they're going to look like. They're not incorporating tariffs, which means maybe once they do, we start to get those downward revisions, that it starts to look more painful. So that's just one of the risks, just relying on earnings as it is now for saving the day when there's so much uncertainty.
Yeah, absolutely. Did you know, by the way, that if you look at ECAN, E-C-A-N, go on the Bloomberg. You can put AI-powered topics in the top and then look at mentions of tariffs for many different indexes. So I'm looking for S&P 500 mentions, and they're 514 in the last quarter. So they at least are talking about it compared to 0, 2 years ago.
Yeah, they're talking about it. Again, that's such a great function to show that because they're worried. But again, they don't know what they're going to look like. So that's really the rub when it comes to it.
All right, Danny Berger is going to continue along with us for the next couple hours. My ECAN man, Joe, is out today. So
ECAN man.
When Joe's here, we see a lot more of that on the screen. Coming up, Chinese EV giant BYD surpasses Tesla in 2024 revenue. We'll discuss the global EV hierarchy next with Craig Trudell. He's been around the world covering autos, and he comes to us next on Open Interest. It's getting out of high interest. Look at what's making headlines around the world. Chinese consumer electronics company Xiaomi kicked off a secondary share sale that may fetch as much as $5.3 billion to fund its expansion into electric vehicles. The Beijing-based company's 750 million share offering is fully subscribed, according to people familiar with the matter. And that offering comes just weeks after EV giant BYD raised a further $5.6 billion, building on what's shaping up to be a bumper year for share sales in Hong Kong. Speaking of electric cars, Elon Musk fanboys have flooded X with mentions, and they are buying the shares of his EV maker as they fall. Individual investors have pumped $8 billion into Tesla stock over the past 13 trading sessions through Thursday, as the shares fell 17%. That's the biggest retail inflow over a buying streak since record-keeping began in 2015. And back to BYD, it is now the largest pure-play EV maker in the world by sales. Full-year revenue at Shenzhen-based BYD was more than $107 billion in 2024. That beats out Tesla's $98 billion without even entering the U.S. market. Net income at BYD rose 34% year over year to $5.6 billion, beating analyst estimates, though Tesla earned a little more at $7.1 billion for the year. Let's discuss the shifts that we are seeing in the auto sector hierarchy. Bloomberg's global autos editor Craig Trudell joins us now from London. And Craig, it's pretty amazing that BYD puts out these kinds of numbers. They've sold fewer actual autos. They don't sell cars in the U.S. or really Europe in size. How are they doing it?
I think it's a matter of supplementing the pure battery electric vehicles with plug-in hybrids. I think that's a huge and sort of underappreciated aspect of this company's business, where, in China and among some, researchers of the industry like Bloomberg New Energy Finance, our colleagues at BNEF, they sort of loop plug-in hybrids in with battery electric vehicles. And I think a sort of huge trend that we've seen is as battery electric vehicles have had a bit of growing pains, even among the likes of BYD, the growth that they've had of late has really been driven more so on the plug-in hybrid side. We've seen a huge response in a sort of improvement in technology there, where you really can sort of solve the range anxiety issue by offering a plug-in hybrid that has hundreds of kilometers of range in BYD's case for many of its models in China.
Well, there was also that news last week that for one of their EV models, they have this new technology that you can charge it in as little as 5 minutes time. Craig, there's also this fascinating story from the FT that BYD was delaying their outroll of a Mexican autos plant because they were fearful that the Americans would steal the technology. It's a complete reversal of what usually happens with America fearful of China stealing technology. Have the tables turned, Craig? Is BYD now the leader and completely outstripping the U.S. in developing these sorts of things?
I mean, my reaction to reading that was, that this is, sort of a continuation of something we've already seen and already known, in the sense that, you think about a company like a Tesla or like a Ford, what have they been trying to do the last couple of years? It's been trying to get CATL, the big battery giant in China, to license their technology for their U.S. factories. A lot of U.S. executives have spoken to this idea that if you want to be more competitive in electric vehicles, if you want to be able to offer lower cost EVs, you need to be able to tap China for their expertise, for their technology, and for their cost advantage. And the U.S. manufacturers have tried to scale up. I think Washington tried to give a big boost in the form of the Inflation Reduction Act. But when you have this sort of back and forth of will we or won't we support this industry, from one administration to the next, you don't have that inconsistency in China. This is a long-term project and one that the Communist Party is absolutely fully committed to.
Craig, in terms of tariffs, what do you expect both in the near term and further out? I guess right away it won't be a surprise if Trump puts 10% tariffs on European autos, but could we end up in a world where European tariffs on U.S. autos drop considerably?
I think it's going to be a huge point of contention, this issue of cars. It's been something that when Trump, rails about how the U.S. Is being treated from a trade perspective, it's one of the first things he turns to. He talks about how many Mercedes and BMWs he sees on Fifth Avenue relative to, the number of Cadillacs that you'll see, say, in Berlin. But I think, the likelihood that we see some tariffs as a result of that being such a point of emphasis seems fairly high, and yet we've seen the industry, really launch this all-out push to try and talk him out of it. I think there's even been, cases where just a few weeks ago, I'm sort of, remembering a Truth Social post from him where he alluded to the idea of, essentially just let tariffs happen. He's really going to need to be talked out of this because he really feels as though, there's a sort of deal to be brokered here that will enable U.S. manufacturers to sell more in Europe. I think what he may be missing in his analysis is, just how little presence some U.S. manufacturers have over here. GM essentially, has pulled out of Europe. And so, just how much there's a sort of opportunity to, for U.S. companies to grow in Europe when they already have capacity to feed this market, right, or they've pulled out and sort of thrown in the towel.
I mean, no European automakers make pickup trucks, but that's because of the chicken tax, right? If it didn't exist, indeed, you might be able to build the market. Craig, great to have your expertise. Craig has covered autos in Asia, in Europe, and in Detroit. So he really knows what he's talking about. Quick check on futures ahead of the opening bell. We have big gains. These are powered in part by Tesla, as those shares are up 4% in the pre-market. S&P futures gaining 1.2%. NASDAQ futures more than 1.5%. We are less than 10 minutes until the opening bell right now. Joanne Feeney joins us next with her top stock picks amid the current market volatility. This is Open Interest.
It's been exactly 25 years since the onset of the dot-com bubble. That's when the S&P 500 posted a record level again at 2000 of March 24th. And it's a level that it wouldn't see again until 2007. So, Matt, obviously we have to relook at this, but I mean, 25 years. It'd make more sense if it was like the 30th year anniversary.
Right. Well, no,
it's a little bit arbitrary, but everyone's freaking out at this moment. Are we in another bubble? Is it unpopping at this moment? So people love to look back to this.
That's why you'll hear so many people talk about the parallels between what we're seeing now in what could be an AI bubble and what we saw then, which was like the telecom fiber bubble, because companies were rushing to spend as much capex as they could, laying down fiber and setting up, the original internet. And you have the same thing possibly going on now, although the argument is there's a lot more return on investment.
Well, you could also argue that the bubble isn't just AI, it's America. It's American exceptionalism. And what we're seeing now is not necessarily just the waning of American exceptionalism, but Germany catching up with spending and China catching up with the spend and effort that they're putting into technology.
Right. Well, that's by design out of the White House, right?
Right. Yeah, I guess it's a feature, not a bug. So what do you do all this with some of the joy coming out of equity markets, though, we are on track to gain 1% when futures open. Joining us now is Advisors Capital Partner Joanne Feeney. Joanne, can we start with that? Is there a fear that there's still this kind of bubble popping sort of scenario leaking through markets? Or is this a buying opportunity with us finally last week getting the first week higher in equities in 5?
Yeah, it's certainly the case that the market, is expensive relative to history. And there's been a lot of chatter about whether this is another moment like the dot-com bubble and bust. I think things are quite different now. The source of the rise, in particularly those AI-related stocks, is very different. And moreover, the potential for them to keep growing has a much better foundation than what was happening during the dot-com era, when a lot of the companies were simply slideware and they didn't have revenues, they didn't have earnings, and they just had hope. That's not what's happening now.
So what do you think is happening now? I mean, if we see, $2 trillion spent on AI CapEx over the next 5 years, is that all worth it?
Yeah, let's look at the comparison, Matt. I mean, when you look back at the dot-com era, there was a lot of spending on the fiber side, right? And that's what we saw sort of blow up. And they said, okay, we've got the fiber laid. It's going to be dark for a while. Is it going to be used? That's not what's happening here, right? The AI chips from NVIDIA and others, those co-designed with Broadcom and Marvell, these are chips that are being used. The question that a lot of people are asking, though, are there applications that are going to make companies money, or are they going to give up on this at some point? So that's what creates the fear, that we might be seeing another bubble. But what's different now is we're seeing more and more applications develop. Even if they're not making companies money as of yet, we are seeing some make money. Look at ServiceNow. They're deploying AI. Look at Salesforce. They're deploying AI. Their customers are using it. They're finding efficiencies in it. And so we're at a point where we don't know exactly how much in applications will emerge, but we're still at a point where
Joanne, we'll talk about all that and more next at the opening bell. We are moments away from the start of trading, and Bespoke Investment tells us this will be the biggest gap higher on a Monday since 2022. I'm Matt Miller. This is Bloomberg Open Interest. You can see futures are up more than 1% on the S&P 500. That has to hold for that fact to be correct. The NASDAQ 100 futures are up 1.5%. So not at session highs, but hovering around that level on really optimism, on hopes that Donald Trump's tariffs on April 2nd will be more targeted than sweeping. You heard the bell on the New York Stock Exchange. If you look down there, you can see Liberty is ringing the bell, and this is a stock that's down 26% year to date, but it has quintupled over the last 4 years. So they are killing it. Down on the NASDAQ market site, you can see Ionis ringing the bell. Their stock is just down 26% over the last 5 years. So if you invested in that, you've lost an average of 6% per annum. In terms of the equity indexes here, you can see at the cash trade, we're looking at the same levels as we were on futures. A gain of more than 1% on the S&P 500, 57.28. The NASDAQ up over 20,000 again. And remember, Mike Wilson from Morgan Stanley, we're going to talk about this in a little bit. He says, now may be the time to buy, as that great rotation we had out of the U.S. and into international developed market stocks, that could be turning back around because of a weaker dollar and a bounce in earnings, or at least a bottom in earnings. The small caps, just for those of you who are still in, up 1.5% there. In terms of specific stocks to watch, really the auto sector at large is one that I'm watching, because BYD has leapfrogged Tesla in terms of full year revenue. Over $107 billion in sales at BYD, only $98 billion at Tesla for 2024. So maybe we're witnessing a shift in the EV hierarchy, because they don't even sell cars in America. They don't really even sell cars in Europe, and still they're doing better than Tesla in terms of revenue. Craig Trudell says that's because they sell hybrids. They sell EVs that have range extenders. GM and Ford obviously sell everything, and they're doing well today on hopes that we see these tariffs targeted. But of course, if you get big tariffs on European autos, that helps these guys with sales as well.
It's remarkable. Tesla up more than 4.5%, even with that BYD news, even though they're getting absolutely trounced in China. It just shows the kind of optimism that we have right now, that tariffs aren't going to be those sectoral tariffs. So, Matt, I'm also watching basically the same thing with semiconductors this morning, because, again, it's this hope that when we get reciprocal tariffs, per the reporting, it's not going to be on individual sectors. So Micron, AMD, Broadcom, Intel, all up at least 1.2% this morning. Again, are Trump's tariffs going to be more targeted than originally thought, providing relief to this sector that, Matt, as you pointed out, had really been struggling in past months?
Yeah, certainly U.S. Semiconductors have had a real problem. Obviously, we've seen NVIDIA come off more than 20% from its highs, but Intel has been a story of failure, really, in terms of U.S. exceptionalism. Wall Street strategists getting more bullish on U.S. stocks, though. As I mentioned, Morgan Stanley's Mike Wilson saying a weaker dollar could improve earnings. And Goldman Sachs' David Kostin says foreign investors will continue to buy U.S. stocks for that very reason, putting about $300 billion into U.S. equities again, which is what they put in basically last year. So some optimism coming out of these big strategists.
That last one, though, David Kostin's reason, is almost a reason to say things haven't bottomed, because people have kept buying. If you look at the flow data, as we've sold off, it's mostly been hedge funds. Retail investors are doing crazy things right now. They're buying record amounts of ETFs. They're buying things like 3 times levered QQQs. We haven't had a bottom in the flows. In fact, we're only down about 7.7% from the top. So given Kostin's note, too, the fact that we have foreigners buying, is this really a bottom in sentiment yet?
Yeah, or you could also ask if people are going to buy the things that they haven't been buying. I bring that up because our guest, Joanne Feeney, has one recommendation on the list that's really underperformed a lot of the others in her group. Let's bring her back in, Joanne Feeney from Advisors Capital. And Joanne, I'm talking about Amazon. Not that it's done terribly, but it hasn't done nearly as well as NVIDIA or Tesla or even Meta or Microsoft or any of the other Mag 7 stocks, Google. You know, it's underperformed all of them. Is that why you like it?
Well, we would prefer it if it had been outperforming all of them, but we still like it here for future positions for our clients. We've owned it for a long time. And the reason I think why Amazon, hasn't done as well as some of the more pure play AI companies is because it's two companies. It's both the Amazon Web Services, where it's obviously, leading the market in providing those capabilities, but it's also an online retail company. And so it's going to move around based on what folks think of the consumer. And when, the consumer is threatened by potentially higher tariffs, slower growth, that becomes a bit of a headwind for them. But, look beyond that to how much share online is still gaining, and Amazon is the leader there.
Joanne, if we do see this pattern continue, that is dollar weakness, do you relook at some of your picks? Do some picks look more attractive if we indeed are entering this environment where the dollar is unable to sustain some of its gains against its peers?
Yeah, I think it's hard to invest based on what you think the dollar is going to do. You look at exchange rates, they're pretty much a random walk. And so, they could shift at any time. And trying to figure out what the dollar is going to do is, I just think it's counterproductive. Find good companies. A lot of the companies that have international currency exposure are going to be hedging that currency exposure. And so, movements from day to day, month to month in the exchange rates, will have some impact, but most likely it'll be muted. So I don't think that's the way to go. I think you're better off finding companies with strong drivers of sales, deep moats that protect their margins. And right now, margins are a big question with potentially those tariffs coming online.
There's a story out about Ant, Jack Ma's company that's developing AI with cheaper chips, apparently with Chinese-made chips. And through that, he's saved reportedly 20%. We saw, obviously, the DeepSeek news in January that was similar, but I guess bigger in terms of its effect on the markets. How do you think this shakes out for NVIDIA, for Broadcom, both of which you like?
Yeah, clearly the U.S. and China are, splitting up, and we're putting, our government and previous administrations have been putting more and more restrictions on exports of chips to China, which forces Chinese companies to find solutions, within their own countries. And that's what we're seeing happen. Claims of performance based on, those chips They're going to keep coming, and they're going to have to make do. That doesn't say, though, that the NVIDIA chips, the AMD chips that are coming online, those co-designed with Broadcom, are not better and will not allow for more applications and more, really deep understanding, more reasoning models, as Jensen has talked about. So I think, we're still in the lead when it comes to chips, and therefore, NVIDIA's, Broadcom's, AMD's chips will still be seeing shortages for looks like some years to come. So that doesn't dim our expectations for those companies, but it doesn't also rule out China's progress, which I'm sure we're going to continue to see.
So it still helps this U.S.-American exceptionalism narrative, Joanne, but as we wait for April 2nd, as we get a drip feed of reports, and let's be honest, there's still so much opportunity for headline volatility as we get to next week. Where do you hide? Where do you stay? What do you buy that helps shield you somewhat for volatility that feels almost guaranteed?
Yeah, Danny, you're absolutely right. Almost guaranteed. We're certainly seeing a lot of it. There's a lot of risks out there. In fact, policy risks have only been higher during the great financial crisis in recent years and during COVID. So investors really do need to understand their own tolerance for risk. In our balance strategy, what we do is build in a lot of higher than average dividend yielding companies so that investors can ride out some of the volatility, and that might lead them to having in their positions, in their portfolios, some positions that might be boring, whether it's a Philip Morris or a Duke Energy or a Kinder Morgan. These are high dividend payers, and you can ride out the stock volatility by owning some of those higher income companies. But also, go to places that are going to be resilient, even if the economy slows down, even if tariffs come on board and hurt growth. Companies like a TJ Maxx that consumers tend to run to when their budgets need to be tightened a little bit. So those are some of the places one can go to build a little bit more safety into portfolios, reduce the volatility a little bit, more consumer staples. That will sort of help ride out some of the volatility that we're going to see in more discretionary stocks and more, information technology stocks.
Joanne, great to get your take in these incredibly volatile times. Investors, I think, need advice like that. Joanne Feeney from Advisors Capital talking to us on this Monday morning. As stocks rise, coming up, some analysts think stagflation is already priced into markets. Bank of America just came out with its strategy to prepare for the worst. We'll talk about that next, right here on Bloomberg. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check at what the markets are doing just 13 minutes into the session. We're looking at gains, and in fact, at session highs with the S&P 500 up now 1 1/3%. Tech stocks really leading the way this morning. As we said, Tesla is one of the biggest movers, one of the biggest gainers on the S&P 500 and on the NASDAQ. NVIDIA, though, adding the most points right now with a gain of less than Tesla, only 2% the gain, but it's a much bigger company, and that's why it adds more points to the index. You saw that the NASDAQ there up 1.5%. That's because the tech-heavy index is going to gain more than the broader S&P. And the small caps, wow, the small caps are up 2%. What's your take on small cap stocks in this environment?
What's my take? That we've had so many false starts. How many years have we come into the year being like, this is it, this is the year for small caps, and it's failed?
But you could say the same thing about buying European stocks over U.S. stocks. This is the year for Europe.
And
this
it was
is
the year.
Their low valuations. They're finally going to keep. They're cheap. And this was the year for European
this
stocks.
is the trick. What everyone was saying at Davos, you do the opposite of. At Davos, they said European stocks would continue to be bad. I unfortunately didn't hear anyone talk about small caps, or if they did, they said that they'd do well. So I'm sorry, that's your barometer.
Let's talk about to sort of carry on where Joanne Feeney left off, because she said TJ Maxx is a stock that you want to buy even if the economy slows down, inflation keeps up. Yeah. They're going to keep churning out steady profits. I don't know if they offer a dividend, but I know you're looking at those kind of stocks.
Yeah, definitely. Dividend stocks and things in general that pay off quality. This is something that Bank of America has been talking about. They say basically you want a straightforward blueprint for clients. If you believe, though some believe, that the market's already priced in stagflation from trade uncertainty. So again, this is a stagflation playbook, Matt. Bank of America telling clients that quality stocks, dividend payers, as you say, are among the groups that outperform the broader market during bouts of stagflation. But again, it goes back to this thing. If you are uncertain, how many people have already started to buy quality? Is quality the only thing that's really been doing well right now? So perhaps it's a trade that you might be a little late on.
I want to just point out we got global S&P Global U.S. manufacturing PMI as well as services and composites out, and they are worse than expected on the manufacturing front. We're actually looking at contraction in terms of manufacturing, so less than 50. The read was 49.8. We were looking for an expansion at 51.7. That's a disappointment. However, on the services side, you have a gain and a bigger expansion, 54.3. We were only looking for an expansion of 51. Obviously, everything above 50 is an expansion. Everything below 50 is a contraction in these indexes. In terms of the composite, much better than expected, 53.5. We were looking for 50.9. So I suppose this doesn't have to be negative news. You can see that yields continue to rise and investors sell off bonds even more. The fact is, we know that this isn't a strong manufacturing economy.
Right.
And even if you're in Team Trump and you think that these tariffs are going to bring manufacturing back to these great shores, it hasn't had time to take effect yet.
Yeah, and it's the same story that we've been getting. The vibes are off. People are pessimistic. People think that the consumer is slowing, that they're not as robust. But again, you look at things like services, the hard data just isn't showing that yet. Is it because it has yet to appear? Or is it because, in general, we are resilient? We
do have stocks absorbing this news fairly well, right? They're still looking at gains of more than 1% on the S&P. In fact, 1.4%. So stocks have not taken any hit as a result of this. And in fact, the gains are even better. I just want to point out that I mentioned TJ Maxx and its dividend.
Yes,
there's a great function on the Bloomberg, does offer a dividend. There's a great function on the Bloomberg. If you type any stock and then follow it with DVD, you can see not only the dividend with historic dividends under it, but you can see our dividend forecasts, which are shockingly solid. So they pay right now a dividend of 37.5 cents cash, and the Bloomberg dividend prediction is for a raise to 42.5 cents. You can see the on the chart, that's the orange dotted line there. So yeah, maybe this is one of those quality stocks that B of A would like.
Well, if the word is uncertainty, if everybody is talking about uncertainty, then maybe you follow the Bank of America playbook and you buy stocks like this that give you a sure thing, like a dividend. Will April 2nd give us that sure thing? And does quality look less appealing if you have some clear idea of exactly what the tariff outlay looks like?
I think the answer to the last question is probably not.
Probably not.
Because all of these things change at a moment's notice.
Correct.
Follow Truth Social. Coming up, more housing M&A as James Hardie Industries makes another housing play. AZEK. They make decking. Investors sell the stock on the news pretty big. That's the James Hardie stock, but they're buying AZEK to the tune of about 20%. More on that next. This is Bloomberg. Let's get you a snapshot of what's moving today, and we've got big gains on the indexes really across the board. Check it out. The S&P 500 now up 1.5% at session highs. The NASDAQ 100 gaining 1.8%. So we continue to climb higher and higher and higher on hopes that Trump's tariffs on April 2nd will be targeted and not sweeping. We even absorbed kind of crappy manufacturing PMIs, although we got good composite services. Check out, obviously, the big kahuna here is NVIDIA. It's up almost 2%, which adds the most points to the S&P 500 of any other stock. But Tesla absolutely soaring, now up more than 7%. That may now overtake NVIDIA in terms of adding points to the index. Obviously, tariffs will be focused on cars. We may get tariffs more on steel as well, at least against European companies, up 4%. You can see Nucor, a gainer there in terms of steel. Semiconductors a focus, so ON is up 3.5%. Fannie Mae and Freddie Mac also putting up some huge gains today, and we know that this is a play I think Ackman is talking about this. Can you confirm, Danny? Ackman is often talking about Fannie Mae and Freddie Mac potentially being brought
an investment there
to
somewhere.
public markets. Yeah, absolutely. And as a result, although we're going to talk about the housing market as well in the next block. Time now for our top calls. Danny, what have you got?
Yeah, look, we got some individual stocks moving on this, on what analysts are focusing on. General Mills, they're getting initiated with an underweight rating at Morgan Stanley. They're up slightly, though, as is everything. The firm saying that earnings visibility is low and it expects sales growth to remain muted. Next up, we got Goldman Sachs. They're cutting Super Micro to sell, citing AI server competition and margin pressure. So those shares not participating in the rally, down nearly 3%. Finally, to wrap things up for you, Jefferies raising Fedex to a buy. They're confident the company can grow earnings, focusing on its cost-cutting plan. So, Matt, those shares up 3.5%.
All right, let's talk about those housing stocks. James Hardie Industries bought home decking provider AZEK for $8.75 billion, a deal that sparked, well, a drop in James Hardie stock, but who cares? It's not even traded here. AZEK is what we care about, and it's up
Australia?
Almost 20%. No one cares about Australia on this desk. I mean, I'm sure it's a nice place to go on vacation, surfing, sharks, whatever. But we're talking about U.S. housing right now. So we're focused on AZEK. And this is really the second mega billion-dollar deal that we've seen in the past week. We saw QXO spend $11 billion for Beacon Roofing. Let's talk about this with Bloomberg M&A reporter Michelle Davis. She joins us now on set. So, Michelle, it looks like there's some optimism for the U.S. housing market.
Yeah, I think what's most interesting about both of these deals is there was this whole narrative that right now, with all of the uncertainty around, are tariffs going to happen? Where are they going to happen? What's the economy going to look like? People were saying industrials deals were really tough. But when you see two deals announced in a week around building products, industrials, it means maybe, companies aren't as concerned as the narrative would suggest.
What about M&A as a whole? Is it remarkable that we got something through the line? Because deal activity in general, you know this better than anyone, Michelle, has been really muted.
So that's the other thing. I was looking at the stats this morning, and we're actually flat on last year at this time. Obviously, after the election, people were predicting, animal spirits, a massive flood of M&A. We haven't seen that yet, but last week, Google announced a $32 billion deal to buy Wiz. That was, something we hadn't seen a lot of. And so it seems like companies are still doing stuff, even if it's taking longer for them to get these deals across the line.
It does seem, though, muted here in the U.S. When you talk to your international counterparts, I noticed a couple of secondaries from BYD and from Xiaomi. It looks like Hong Kong's on fire, right? Are there other places in the world where M&A is actually happening?
We're seeing a lot more in Europe and the UK, but the one theme that we keep hearing is that these cross-border deals are harder to do just because, geopolitics are changing by the day. And so it is harder for companies to lean across oceans to do big deals.
All right, Michelle, thanks so much for joining us. Michelle Davis from the M&A team on the other side of the building here. Coming up, actually, let's take a look at markets.
Yeah.
Because we're still sitting at session highs, right? The NASDAQ up almost 1.9%, the S&P 500 up 1.5%. And it's really interesting to me, especially that Tesla is now up more than 7%, even though BYD came out with better results.
That, I think, really underscores the shift that we're having today with this hope that not necessarily its tariff is going to not be volatile, because we know that we might still get more announcements, but maybe just that the sell-off has gone far enough. So you can go in and buy things like Tesla. Again, Matt, we're probably going to get some more truths put out there, some more differing ideas on what trade tariffs might actually look like. So how much can the calm really last? Right.
And I can see, these tariffs, if you get 10% on European autos, very helpful for GM and Ford. I guess it would help Tesla as well. Dan Neal from the Wall Street Journal had a story out defending his purchase of a Tesla Model 3, even though Elon Musk. All right, coming up in the next hour, Shana Sissel joins us from Banrion Capital Management, Mark Morelli of Vontier, a charging stock, and Mark Douglas of Mountain. This is Bloomberg. 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger. Sonali Basak and Katie Greifeld are on assignment. Coming up on the show, measured moves, stocks rise on signs that President Trump's next round of tariffs may be more targeted than previously threatened. Charged up, BYD captures the world's attention, beating Tesla on revenue. We'll discuss the EV market with the CEO of Vontier. Plus, a streaming hit, Severance draws a surge of subscribers to Apple TV+, but just how many new subscribers will stick around? And Matt, we've got a rally on our hands.
Yeah, absolutely. Taking off here for a Monday, as you pointed out earlier. I guess Bespoke Investment Group says this is the biggest gap higher that we've seen on a Monday since 2022.
Yeah, a really solid showing. And is it all just because of tariffs? Is that the thing bringing us through? Well, there are also some stocks moving this hour. Let's get a look at that. Joining us now is Bloomberg's Denitsa Tetskova. So that's the overall stock picture this morning, Denitsa, but you've got your eye on Fedex. Kick
For
it off.
sure. We have some micro names that are also winning. Fedex is being boosted to buy from hold in Jefferies. Of course, that comes after a very tough Friday for the stock. Now we're seeing a move higher. The stock is up 4% after a drop of 6% on Friday, so it's reversing a lot of those losses. Jefferies is bullish on the stocks because they think the company can get through all those issues they talked about in the earnings, and also they're in cost-cutting mode, which is bringing some optimism. It's interesting that they cut their target to $275, even though they upgraded the stock, but this is still 15% upside. Everyone was worried on Friday because FedEx were talking about weakening consumer and impact from tariffs, and clearly this is everything everyone's looking in the earnings report. And also they lowered their full year guidance for a third consecutive quarter. So it was a pretty rough end of the week, but now we're seeing a lot of relief. So potentially there may be more optimism from here.
Well, Denitsa, speaking of worries and turnarounds, I feel like I saw reports on Friday that Lockheed Martin won the Pentagon's contract for the next generation fighter jet, and then Boeing won it, right?
Yeah, well, in 2021, it was Lockheed. This year, obviously, it was Boeing. And we're seeing a massive difference in the reaction. Obviously, Boeing is the clear winner. We're seeing upgrades coming from Melius that upgraded Boeing to buy, and then they downgraded Lockheed to hold. What we're seeing is Boeing is up 2% today, while Lockheed is down 2% today, which kind of mirrors the reaction we saw on Friday. Obviously, Boeing saw a big boost and is now actually up year to date, which is a big boost after a very rough 2024. Of course, this comes after the announcement of the White House of who's winning the contract for the next fighter jet.
F-47, by the way.
Yes.
I love that.
Yeah. But we don't know the price tag. President Trump said something in the sort of 100 billion. So we heard other estimates about 20 billion. We're talking about a really big sum of money.
Per plane, we're talking about.
Yeah. So clearly,
I
thought we were going to get cheaper planes this time around.
I thought we'd get unmanned planes, right? Didn't Elon Musk say, like, it's so silly that we're still putting people in these?
Exactly. He said we should have drones instead. But clearly, it's not happening now.
I think we have those two at least. Maybe a healthy combination of people. Anyway, let me save myself from this, Denitsa. NVIDIA also moving higher. I mean, it's remarkable that the AI Super Bowl last week couldn't get NVIDIA to move higher.
Exactly.
But macro news is this morning.
Yeah, macro news is moving NVIDIA. Last week, as you said, NVIDIA was down 3%. Everyone was so excited about the Super Bowl of AI, the GTC conference. And it was full of announcements. It was a good week for NVIDIA, but just investors weren't as excited. We saw that crazy co-buying in previous events, and now people just wasn't chasing that upside. Today, of course, we're seeing the macro news of the tariffs not being so sector-specific, and especially not starting April 2nd, which obviously is just around the corner. So we're seeing a lot of relief. The stock is up about 2%. It's still having a very rough start of the year. Of course, this company was up 800% last year. Very rough start of the year, but there we can see that it reacts to macro events, to earnings, so it can reverse fortunes pretty fast.
Yeah, I'll take a 20% decline after a 2,000%.
It's fair.
Increase. Denitsa Tetskova, thank you so much for joining us. I want to get right over to our guest, Shana Sissel from Banrion Capital Management. She's the CEO and founder of that company. And Shana, we have had real concerns about the macro, about the tariffs. That's what knocked the S&P 500 down to 5,500. But we're trading back up now to 5,750. Have we priced in a stagflationary economic growth scare?
Well, I think the market has certainly adjusted itself to the potential for stagflation. I don't know if it's fully priced in. I think some of the more positive economic news and the more positive market last week may have taken out some of that risk. But I think the risk is real, and I think the market should be adjusted for that. But as somebody who's a long-term investor and focuses on fundamentals, I see this more as a nice entry point. If you look through history, it's times like this where you make most of your money is when everything's kind of beaten up. And so right now I would be looking to buy on the opportunity to take advantage of a short-term dislocation for the longer-term win.
Shana, can I just challenge you on that and ask how much pain has there really been? We're only down some 7.7% from the high. Retail has continued to buy. David Kostin pointing out that foreigners have continued to buy. Do you need that type of capitulation from retail especially to be confident that we won't have more pain to come?
Well, like I said, I think that the market took out some of the risk of stagflation, and I think that it needs to be put back into the market. I actually am saying exactly what you're saying, which is that we had a 10% correction. That's a correction. It's not really suggesting that a lot of the over exuberance is taken out of the market. Yes, to your point, you need to have like the retail investor kind of scared out of the market before going back in. But that said, in some pockets of the market, you are seeing that. You mentioned NVIDIA. I'm a huge NVIDIA bull, and I have been for a while. I've been on this program before and talked about it. When you see a stock like NVIDIA, whose long-term trends are quite positive, trading down so much, that to me is an opportunity to step in and buy while it's in an attractive valuation. I'm not looking to pick a bottom, but I am looking to buy stocks at a much more attractive valuation. And some of the names that we were all complaining about last year were too expensive, that valuations were inflated, have now come down and are much more like in line with what they should be, much more attractive on a valuation, much more at a discount than they were. So as an investor for the long term, I'm not worried about finding the absolute bottom, but I am looking to buy things at a valuation that makes sense. And many of the areas of the market, specifically some of the AI names, are there, and I would be a buyer on that.
I mean, as we always say, you can't get fired for buying NVIDIA, Shana, but you could for buying Nike. The stock is down, what, 45% over the past 3 years. They're still firing executives. They're still trying to turn things around by focusing on sports, but also like influencer underwear. So why do you like the stock?
So I like this stock because, first off, I have a 9-year-old, and he is a Nike fan, and his friends are Nike fans. And I really believe that Nike will turn this ship around. They have already made some really positive changes in their senior executive leadership, and they are really thinking about, how do I pivot to take advantage of changes in the consumer markets and the way things are sold to take advantage. If you think about what made Nike so famous to begin with, it was working with Michael Jordan and taking that risk. And this pivoting to the influencer market, I think, is a reflection of how consumers really find the new trends, where it's not on ads on TV, it's on ads on your Instagram feed. I'm always being influenced by the ads on my Instagram feed. I wish I wasn't. But taking that and being thoughtful and pivoting, I think Nike is a brand leader. It certainly hasn't lost its cachet from that standpoint. It's just a matter of making adjustments and pivoting their approach to be able to take advantage of how consumers get their ideas, their trends, and follow them. And that is actually in the influencer market, but it's also in the athlete market, and they're starting to turn that way again, too.
Shana, unfortunately, I too am very easily swayed by online targeting. I think I am an advertiser's dream in that regard. But for these consumer stocks, as they try to right the ship, just how much more complicated is it with a period that it feels, again, we have it yet to show up in the hard data, but it feels like one of a consumer slowdown. Survey data has gotten worse. You have the airlines talking about people being less willing to spend on airline travel. Does it make the likes of a turnaround for Nike and others trying to do the same thing that much more difficult?
It does, but it doesn't make it impossible. And again, I'll go back to where I started, which is that when things are really negative is when you want to be buying these trends. When it looks bleak is when is typically the best time. It's also when you typically make your best returns. So when you see these stocks, which I believe are going to be long-term winners, trading at massive discounts on valuation, under a lot of pressure, in the midst of a rebuild and a refocus of the business model, that's an opportunity to buy. Now, it's not always going to work. Value traps are value traps for a reason. So you've got to look at things on their merits. But I think with consumer stocks, there are places to kind of pick. And I think Nike's one of them. But on the flip side, you got Target, which has done better recently, but still hasn't really figured out how to compete with its peers in that discounted retail space like Walmart and the like. And so that's a stock I'm not necessarily looking at. But like a Nike, it's not as if like Adidas or somebody else is just absolutely like beating them and people are going there in droves and they're losing. They have to get back into like the consumer's good graces, but it's not as if there's somebody else that's doing it so much better that they won't be able to remain in that number one spot. And at a discount, I would look at a stock like that, especially at a time where the consumer may be going and struggling and not purchasing as much, because that's going to allow me to take advantage when things turn around.
Strong argument, Shana. Thank you so much for making it here on Bloomberg. Shana Sissel there of Banrion Capital Management. Coming up, law firms in the presidential crosshairs. We're going to give you the details next in our Wall Street Beat. This is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. Debt markets are facing a reckoning after years of complacency start to weaken, according to Victor Khosla, the founder of Credit Investor Strategic Value Partners.
You just have had much higher defaults than you would expect. What is happening underneath the surface is just frantic activity.
Consumer sentiment and industrial growth are starting to drop as a result of his firm. His firm will lean, I should say, further into consumer, industrial, and manufacturing investments. That's according to Khosla on surveillance. It's also time to start ramping up its property exposure, Khosla said on the show. Now, Jack Ma-backed Ant Group used Chinese-made semiconductors to develop techniques for training AI models that would cut costs by 20%. This, according to people familiar. Ant used domestic chips, including from its affiliate Alibaba and Chinese consumer electronics maker Huawei, to train models using the so-called mixture of experts machine learning approach. It got results similar to those from NVIDIA chips like the H1800. And the private equity industry is pushing to change the way taxes for indebted businesses are calculated, seeking to add depreciation and amortization to the earnings formula used to determine tax deductions. That would generate bigger tax deductions for heavily indebted companies, boosting savings to up to 15% in some cases, and increasing returns for the PE firms that own them. The industry's lobbyists are forming alliances with manufacturers and other industries to amplify their voice on the Hill as Congress works on a new tax bill. Danny?
And some real optimism that this administration will be amenable to that. Now it is time for your Wall Street Beat. And with that, President Trump is ramping up his attacks on law firms. He's directing Attorney General Pam Bondi to pursue sanctions and disciplinary actions against lawyers who engage in, quote, frivolous or unreasonable litigation against the United States. This comes after the firm Paul Weiss dropped DEI hiring and promised pro bono services to topics favored by the administration. All of that under pressure from the president. Joining us now is Tatiana Monet of Bloomberg Law. Tatiana, great to see you. What exactly was this executive order signed by Trump, and why does it have some law firms, concerned?
Well, law firms are concerned because, one, they don't want to be the story here. They're normally used to operating in the background. And two, the possibility of being hit by sanctions and disciplinary actions for the type of work that they engage in is what many say is sort of dancing on a dangerous precedent.
So I wonder how these law firms have responded, Tatiana, because if you have issues with certain industries, it can be problematic due to litigation, but I would expect even more litigation coming from law firms themselves.
Yeah, I mean, we are in sort of unprecedented times right now. The response so far from attorneys has been, in private, they are chatting up a storm. This, I mean, this is something that everyone is worried about. Everyone has something to say. They're sort of pleading with the leaders of other big law firms to stand out and say something strongly against these sanctions. We're not really seeing that reaction publicly. Because everyone is scared that they're going to face the same fate as a Paul Weiss or a Perkins Coie or a Covington and Burling, which have all faced sort of a different set of memos or executive orders that, restrict their access to federal buildings, which is sort of essential for litigators to sort of stand in court for their clients and argue on behalf of that. And so right now we're sort of seeing just over the weekend, in response to this Friday executive order, we've only seen a couple elite litigation boutiques like Selendi Gay and Kecker Van Nest say this is not okay. And there are more sort of throughout the industry privately pushing for law firm leaders to say exactly that.
Tatiana, Matt kind of hinted at this, but we do feel like we're entering this time where there does seem to be more litigation, or at least the threat of more litigation, against the Trump administration and some of the various moves that they're doing. Does this type of action, does it help alleviate for the Trump administration some of the fears? Do we have any sense that some law firms would be pulling back in action that they might take against this administration?
That's a great question. I mean, I think that the need for litigation over the next year will not go away. Over the next 4 years will not go away. We'll have to see what kind of chilling effect these executive orders may have. I think you will see a set of firms that will stand and say, okay, we are going to be the ones who will pursue this litigation, because you will see another set of firms that will be discouraged strongly against pursuing this type of action, because, again, they don't want to face the same fate as a Paul Weiss or a Perkins Coie, where they're not able to go litigate in court, and that impacts, their ability to get hired for work and their ability to keep their clients and keep their billing and their billing up high. So we'll have to see exactly the risk calculation that firms are going to have to make over the next 4 years, and if they're willing to put their bottom lines on the line for this litigation.
Tatiana, great having you on the program. Thank you so much for joining us. Tatiana Monet there from Bloomberg Law. Still ahead, prepare to pay more for airport lounge access because they're all completely packed. Everybody's a member. We'll explore the latest moves by United next. This is Bloomberg.
Let's get you some social climbers. The company's making waves this morning. First up, 23andMe. They have started their bankruptcy proceedings to help facilitate a sale. The Chapter 11 plan is the latest chapter in the saga of personalized DNA testing company. It was at one point valued at $3.5 billion when it went public 4 years ago. Next up, we got Dun & Bradstreet for you. It's one of Wall Street's oldest data providers and consultancies. It is being bought by Clear Lake Capital Group for about $4 billion. Here's a fun fact for you. 4 U.S. presidents, including Abraham Lincoln, Ulysses S. Grant, Grover Cleveland, and William McKinley all worked for the company. So there's that. Finally, United Airlines. This one might make you upset. It's going to start charging customers more to access the airport lounge, trying to combat overcrowding. Membership will now cost $750 or 94,000 reward miles a year. Matt, I don't know, I tried to get into the Delta Lounge literally this weekend, and it's so difficult to do. I feel like already all these airlines are trying to make it as hard as humanly possible to use their lounges.
Yeah, I think they're just trying to make the entire experience horrendous for consumers, unless you're willing to pay the thousands of dollars that they charge for business class and first class tickets. By the way, I Googled the Dun & Bradstreet thing, because it's weird that 4 U.S. presidents would work for this giant data company,
Correct.
right? Although the names you mentioned were much older.
See, that's what I was thinking.
U.S. presidents. Apparently, they worked not for Dun & Bradstreet, as it is now named, but for its predecessor, I guess, company called the Mercantile Agency.
Okay, because that makes sense, because I'm like, why is Ulysses S. Grant processing big data? I don't think during that time that was a concept.
I'm pretty sure they also worked for the Mercantile Agency before they became U.S. presidents.
Okay, well, Clear Lake then buying a piece of history. I guess there's some sort of
It
premium
sounds like
on that.
more of a club, you know?
So you think they buy it so they can be like, we hang out with all the people who used to hang out with
I think they were
ex-presidents?
involved in like a business roundtable of sorts.
I feel like you're getting into conspiracy territory, Matt, and maybe we put a pin in this one.
I'm not sure that they were like paid clerks at Dun & Bradstreet.
Okay, yeah,
is my point.
I think that would make sense.
Let's get a quick check on markets. Absolutely ripping for a Monday. The S&P 500 gaining about 1.6%, the NASDAQ up 1.9%. The idea is that President Trump's tariffs, which he will announce on April 2nd, will be more targeted rather than sweeping, although sources inside the White House talk about negotiations. And as we all know, these things can change on a dime. Coming up, the race to perfect EV charging is heating up. Vontier CEO Mark Morelli joins us next. This is Open Interest. Last week, the autos world saw a breakthrough that changes the game for drivers who need to refuel in a hurry, specifically drivers of electric cars who need to refuel in a hurry. Chinese EV maker BYD said its new battery and charging system can add 400 kilometers of range to a car in just about 5 minutes time. That's like 250 miles for those of you who speak American. Vehicles with that system hit the market next month. Our next guest runs a company that operates in the EV market by providing both physical chargers and software that allows EVs to communicate with cars, with the chargers, and manages charging networks as well. Mark Morelli, the CEO of Vontier, joins us now. Mark, first off, what do you think about this breakthrough? 5 minutes in 250 miles in 5 minutes sounds like a lot, I think, to most people, but I guess you've got to have everything right for that to work.
Yeah, well, it's exciting technology, and we know from our customers that time to charge is a big deal when it comes to further build out of the electric vehicle car park and adoption. But, you know, it's not the only thing. I mean, we see this exciting advancement, but it's going to be a long time to roll out this technology because of a couple things. One of the biggest issues is also around EV adoption itself. And some of the things that hold it back are location of chargers, the speed of the charger, which we're talking about here today, but also the reliability and uptime. And the number of chargers needed is pretty significant. And what this technology really says is that a lot more investment is needed in this infrastructure. And this is a very costly infrastructure to roll out. And with a 1 megawatt charge, which this is asking about, or really saying which is needed, then that says that that whole infrastructure, including the grid, needs to move forward too. So there's a lot of technologies needed to move this forward.
And it's China, where they're willing to put in that investment, Mark, where they're backed by the government, where something different is happening in the U.S. What do you think is the ability of America to keep up with this type of technology, to get something that looks like what BYD is promising in super fast charging networks?
So, you know, you bring up a really valid point because it requires the government to really step forward and make that kind of investment. The infrastructure today for EV charging electric vehicles, you know, it's a small part of all vehicles on the road, and that infrastructure works, but it only works for the early adopters. And as you sort of tip into how do you start attracting the mass market for EV drivers, it really requires a lot of incentives to be able to put that infrastructure in place. And you see that going forward in China. But not only the number of chargers, think about the amount of electricity required. So what BYD is talking about is 1 megawatt per charger. And that's equivalent to about 2 Whole Foods grocery stores in terms of the amount of energy required. So there also needs to be a build out on the electrification infrastructure, and then you've got data centers on top of that. So there's a lot of competing demands to be able to advance that EV technology. So we believe that it will advance, but it's not going to advance at the rate of what people have thought.
I mean, are you actually confident that the U.S. electric grid is up to snuff or can be brought up to snuff in the near to medium term?
Well, it can be brought up to snuff, but it requires a lot of investments to get there. And I think, once again, this technology really shows that there are many pieces that need to move forward. You know, another piece, too, is think about the vehicle to be able to accept this kind of charge. You have to operate on a platform that really is in its infancy. There's hardly any vehicles on the road today that would be able to accept this rate of charge. So that's a big investment from automobile manufacturers. So it's multifaceted, where you see many things have to occur to move past this early adopter phase into more mass market in the United States. So we believe it's coming. It will just take time. It's going to take a lot of investment, which is why we also believe that it's going to be a multi-fuel future, and consumers going to want to look at optionality.
Mark, quick question on the vibes. You're not a Tesla company, but I wonder, have you seen any attacks on your infrastructure? And, you know, I've seen chargers that have been, many chargers, not yours, but others, your competitors, that have been broken for long periods of time, even pre-Tesla backlash. So how are you dealing with that?
You know, what we do is we provide the software and capabilities to make the system a lot more reliable, and we work a lot on uptime, which has been a big problem for the industry. But as we advance our technology, we see folks getting much better at it. So, you know, it's hard to control the public opinion around that. We are, by the way, hardware agnostic. We're also vehicle agnostic. So we're not necessarily subscribed to Tesla, and we don't necessarily fall into some of the traps that Tesla might be falling into. But at the same time, I think it shows that there are a lot of challenges out there to get this infrastructure right. And we also provide, we're one of the world's leaders in providing the petrol-based infrastructure. And if you look at fleet operators, look at compressed natural gas, renewable natural gas, biogas, which Vontier is also positioned there. So I think it's about bringing our customers forward in a very realistic way. While we love EV charging, we're one of the leaders in the world of providing that infrastructure. It's going to be optionality for many decades.
I just wonder, Mark, and this is almost another way to ask Matt's question, is what's bad for Tesla bad for the entirety of the industry? If you start to see a backlash because there is this connection, rightly or wrongly, to Elon Musk and political affiliations, which, let's be honest, he has been very close to President Trump. If we are seeing a backlash to Tesla, does that seep in to the wider industry? Have you seen any impact, or does it remain very idiosyncratic to Elon Musk's company?
You know, I think if you asked that question 5 years ago, I think it'd be kind of very different where we're positioned today. I mean, look at the OEMs that are out there advancing their products, very exciting products coming to market. And I think that the car park, as it evolves, you know, it's going to take more than one company to make that evolution. And I think you see that. You see a lot of OEMs, not only the U.S., but also in Europe, stepping forward, and clearly folks around the world. It's more positioned where it's not just one company. And any sort of mass market adoption of something like electrification for the car park is going to require the whole ecosystem moving forward. So I don't think that it's up to one company to make this happen. It's up to the many companies to make it happen.
Mark, great to have you on the program. Hope we get you back. CEO Mark Morelli from Vontier talking about the charging infrastructure and petrol infrastructure that company provides through its software and services. I want to get a quick check on what's going on in the markets. You can see we're looking at still gains of 1.5%, 1.9%. In fact, we don't really have to check that often if it just stays like this, right? We can say, look, we're on fire today. This is the best Monday we've seen since 2022.
Since 2022. And on what? It's on tariff headlines, and there's expected to be more volatility. So maybe that just underscores the volatility. Because, Matt, that statistic is so surprising because we had record after record last year, and we didn't get that. It's the best since 2022.
It is shocking, and we didn't have that driven by AI on any Monday last year. But very interesting stuff indeed. Let's take a look at some of the...
I was going to say, what seems to be driving it is Tesla. So I want to get into some of the individual stocks. Joining us now for the stocks moving is Bloomberg's Bailey Lipschultz. And Bailey, I mean, Tesla having such a killer day, even though BYD looks to be besting it.
Two great moves, and as you mentioned, Tesla up more than 10%, best performer in the S&P 500. It does come on the back, Matt, and I'm interested in your thoughts. BYD now more than $100 billion in sales, beating Tesla on the full year 2024, first time in a few years. But as you mentioned in that interview, is good news for BYD inherently good news for Tesla? One thing that jumped out to me from the Bloomberg story, total deliveries, BYD sells both hybrids and EVs. They sold 4.27 million cars, as much as Ford Motors. So this is a company that's more diversified than a Tesla, which typically leans into EV first and obviously trying to lean into that robo-taxi. But we are seeing BYD ADRs trading here up more than 5% and Tesla up more than 10%.
Yeah, I think it's pretty shocking that BYD had such amazing revenue on sales of cars in places outside of the U.S. and Europe, right? Because they don't even sell cars here. And they sold fewer electric cars than Tesla in terms of total units. But your point that they also do well with the hybrid powertrains is something that Craig Trudell was telling us earlier. That's something obviously Tesla doesn't offer and that a lot of consumers want right now.
Yeah, and expanding into regions like Singapore, obviously working out for the company. Again, looking at it year to date, ADRs up 56%. Tesla shares, down more than 30%.
By the way, caught my eye yesterday that we saw another multi-billion-dollar deal in housing supplies, I guess, right? AZEK makes decking, and some Australian company bought them for almost $9 billion. Plus, last week we had QXO, I think it's called, buy Beacon Roofing and Supply for $11 billion, or in a deal valued at $11 billion, including debt. So that's $20 billion in a bet on housing over two deals in the last week.
And the thing that's interesting, James Hardie, that unnamed Australian company, was down about 15% in Sydney trading. This is a company that is leaning into generating more revenue here in North America. So this is a bet at a time when we're so uncertain about the strength of the U.S. consumer, their ability to, redo their siding on a house, or, as you mentioned, add a deck. Management from James Hardie coming out defending the deal even after the stock slide, just saying this is a bet that in the long run, tariffs aside, people are going to need to renovate those houses. He called out a stat on the millions of U.S. homes that are older than 40 years. My home's closer to 100 years, but needing to redo those sidings and maybe putting on decks. But again, interesting timing with these two big deals when every other day it feels like tariffs are worse than expected and also the U.S. consumer is feeling a pinch.
One of my favorite things about this story is they held the call on a Sunday. So these poor analysts were dragged onto the phone on the Sunday, and apparently the Americans were super pumped about this deal, and the Australians were just shooting it down left and right. So,
because they don't like to work on a Sunday?
I don't think...
hungover?
I was going to say Americans...
March Madness. They're watching college hoops, drinking a beer, listening to an earnings call. I'm just saying.
One screen earnings call, other screen NCAA. One is on mute. I'll let you guess which one. Bailey, let's just wrap it up with Fannie and Freddie. Some news there from the Journal.
Outperforming again. This is a stock or a pair of stocks that are up more than 250% each in the last 12 months. Bill Pulte, head of the Federal Housing Finance Agency, basically ousting the boards of these two companies, pushing for and making himself the chairman. Another question of will they or won't they be privatized? A lot of hurdles to get to that kind of finish line, but this has been something we've been tracking for the better part of the year, especially when the likes of Bill Ackman has come out and kind of laid out his thesis on how this could all play out. So certainly something to keep an eye on, because these potential IPOs would raise tens of billions of dollars and be pretty notable not only for investors, but also U.S. consumers.
All right. Great having you on the program. You and your 100-year-old house, Bailey. Thanks so much, Bailey Lipschultz, there, New Jersey-based homeowner. Coming up, Apple loses over $1 billion a year on streaming. Or is it Apple only loses $1 billion a year on streaming? We'll talk about that with Mountain CEO Mark Douglas. He joins us next for a look at the streaming wars and maybe a little talk about Formula One. He owns a team. This is Bloomberg Open Interest. Let's take a look now at Apple's streaming struggles, or are they? It's losing $1 billion a year on its streaming ambitions. Is that too much, or is it fairly little? It's obviously a drop in the bucket for the company, which is valued at more than $3 trillion. It highlights just how tough, though, it is for companies to come close to the financial firepower of Netflix. Here for more on the streaming wars is Mark Douglas, president and CEO of Mountain, an advertising software company. So he knows a lot about these kind of things. And Mark, I mean, Netflix, I guess it's been in the game longer, but they don't have nearly as much money as Apple to put behind content. If they wanted to, Apple could blow them out of the water, right?
Yeah, I mean, certainly they could. But the thing to remember about Netflix and Apple, for Netflix, TV, streaming TV is the entire business. It's the entire focus of the company. For Apple, even if you just isolate their media properties, it's just a portion. They have Apple TV Plus, music, games, fitness, news. And so Apple really views all of these things together as the game they're in. And I think it gives them a very different perspective than you would have at Netflix or at Disney or any of these other media companies.
Well, some of these I get, Mark, because you have to be in the Apple ecosystem to use them. In order, for example, to use something like an Apple Fitness, perhaps you want an Apple Watch, a device. But with Apple TV, you don't need it. I mean, I watch Apple TV on my Roku, for example. So how does that fit into the whole ecosystem stickiness kind of aim that they're trying to achieve?
Yeah, well, you have to think about what the goal here. Really, what Apple wants to do is they want to tax you as an Apple device user. So they want essentially every person that has an Apple device, let's say an iPhone, to essentially have a subscription. And they have all these services so that one of them, at least, hopefully two or more, are going to entice you to do that subscription. And so that then becomes, they're not just selling the device. They now have this ongoing thing. The interesting part about it is for everything else, you look at music, they're licensing the music. You look at games, they don't build games. But for TV, they can't license the content, so they were forced to start making it. And that's costing them billions of dollars a year. That's why they're losing money on that. But again, I think they're just in a different game. They're looking at it as how do they add this, subscription revenue stream to their business. And they don't really care what you adopt to use it, as long as it's one or more of those services.
By the way, how are they doing in terms of $1 billion a year losses? I think it's $1.1 billion a year that they expect to lose on streaming. Is that a lot in your estimation, or is that peanuts for Apple?
I think it's peanuts, but not so much in the sense of they have a lot of money. I think they're thinking of it as like, okay, how much are we making? They're probably making a ton of money on music, right? And so they're looking at the whole subscription portfolio and saying, are we making money on the entire portfolio? I do think there's a possibility at some point they say, do we even need TV to get kind of, we'll call it the Apple Entertainment subscription. Let's give it that label. Do we even need TV? And if they decided they don't, that it's not really what's driving people to subscribe, maybe music is the leader or fitness or something like that, then I think there's a possibility they could sell Apple TV Plus. At the time, I think they thought they really needed it, and I'm 50-50 on whether they do or not as an individual right now.
Well, in terms of other changes they could make, I mean, Mark, your day job, among the many interesting things you do, is at Mountain working with brands for advertising, giving them a platform. We've seen all the other streamers, most of them offer something of an ad-based tier. Netflix went into it, Disney, Amazon. Is Apple next?
There are rumors that they are, and again, I don't think their heart's in it. The only advertising revenue they have is really the App Store, and that's barely advertising revenue. So I think it's a possibility, but if I laid my money down, I'd probably say not, that they just never fully get there.
I just got to ask about F1 because you're a sponsor of the BWT Alpine F1 team. I saw Pierre Gasly was disqualified yesterday because his car's too light. What's your take on that? And what's it like being involved in a sport?
It's a lot of fun. We do it for our customers, and we also have, meaning the team at Mountain, we also have a real passion for the sport, but it really started as a way to spend more time with our customers and kind of reward them. But you know, it's real. Like we get emails from the team constantly. We know, like the moment Pierre gets disqualified, there are text messages flying. So you're really a part of the team, and it brings a lot to us in terms of, you know, our sponsorship and so forth. So we're very happy with it, and we're pretty excited about this year and the continued growth of the Alpine team.
Mark, do you have the best rookie on the grid this year? There's so many. It's been prime entertainment.
Look, I don't want to be that dad that just kind of says, yeah, my kid is the best. I think I'll put it in, we're excited. I think, you know, every driver has to prove themselves, but I'm really excited. Yeah, I've met Pierre many times. I'm really excited. He's a very competitive guy, and I think Pierre will find a way to win. So I'm excited.
That's the kind of parenthood we call tough love, and I think it's appreciated by a lot, Mark. Mark, thank you so much for joining us. That's Mark Douglas of Mountain. Coming up on Bloomberg Technology, which will be anchored by your very own Matt Miller, an interview with the DreamWorks CEO, Jeffrey Katzenberg. Matt, looking forward to that one.
Yeah, I'm looking forward to it as well. He is concerned about the harm social media does to kids and trying to stop that with Aura. And we'll have that conversation. By the way, did you know that Mark Douglas's company, Mountain, their chief creative officer is Ryan Reynolds, who actually owns a stake in the Alpine team?
He is a busy man, Ryan Reynolds, but as is Mark, so a match made in heaven.
Yeah, absolutely fascinating stuff. We are going to continue to talk about these markets ripping face and focus on Tesla, certainly in the Bloomberg Technology Hour, because that stock is killing it, up 10% as hopes of targeted tariffs help trump fears of a sweeping tariffs. This is Bloomberg. Let's go ahead and check on these markets again. At session highs right now, with the S&P 500 gaining 1.6%, the Nasdaq up almost 2% right now, and investors are selling treasuries as well, driving yields higher. So the 10-year yield up over 430 at 431.92. It's so fascinating to me, Danny, that this is at least purportedly on the back of traders optimistic for Trump tariffs on April 2nd. Like, so much could happen between now and then.
Yeah, every single day it feels like there's a decade's worth of news, so 100%. And even moving higher in the face of Tesla not doing as well versus BYD, and the fact we had PMIs, Matt, this was in the PMIs, that firms' costs are now rising at the steepest rate in nearly 2 years. There's that stagflationary kind of flavor coming through it, and we're totally looking past it.
Yeah, absolutely. You saw the same thing happen on Fed Day last week, right? They said, inflation's going to be higher than we previously projected, and growth is going to be slower, and yet the market rallied after that. So I guess the question is, is this all priced in already? Do we think the drop to 5,500 was enough?
Or it's maybe that thing when you're concerned about the weather, you can only look at the storm clouds ahead of you. You can't think of the hurricane coming down later the road. So the soonest thing is the April 2nd deadline.
It's been a pleasure having you with me here on Bloomberg Open Interest. I'll be with you tomorrow. Seema Shah, Amy Wu Silverman, and the founder of Kind Snacks. This is Bloomberg.